First up today, we have a keynote presentation by Sam Berridge, Portfolio Manager at Perennial Partners. Sam, welcome back.
Thanks very much, Paul. Glad to be back on the show again. So I'll rip right into it. So the commodity sector, which is what my fund invests in, sits at the intersection between two massive thematics. One being decarbonisation, and the other one being the global macro. And there's plenty going on in both of those things. One part of which I will touch on. But if we tick onto the next slide, you can see that being at the intersection of those two thematics has been a pretty good place to be for the last 3 years. We have outperformed both the ASX 200 Resources Index, but resources as a whole has outperformed the S&P 300. So moving on to the next slide, you can see our 3-year number is sitting around 15%. And our since inception number is sitting just under 30% there. So to my point, despite the fact it has been a rocky period in markets over the last 18 months or so, commodities as a sector has performed reasonably well, and as has the fund. But as I mentioned, we sit between decarbonisation and the global macro. But within that decarbonisation thematic, which is often spoken about, for the first time, what we're seeing is perhaps a little bit of a pivot on how decarbonisation will be addressed. So if we can move on to the next slide, we've got some charts on that. Firstly, the rollout of large-scale renewable projects is running into some headwinds in Australia and also around the world. That chart on the left shows the number of renewable projects taking a final investment decision. So that's the chart for Australia, but also offshore. There's been plenty of headlines around about some of the trouble that particularly offshore wind is having in achieving FID in the current cost environment. The economics for those projects are somewhat challenged. And investors are picking up on this. And so you can see on the right, there's been a divergence between the performance of the global solar and wind ETFs, which have rolled to the downside. And conversely, uranium and nuclear ETFs have done quite well over the last couple of months. So, as usual, the what is nowhere near as interesting as the why. So we might just dig into that a little bit on the next slide. So renewable projects are running into a couple of issues. I mean, they have cost capex increases and higher interest rate challenges, the same as every other business, but they're also running into a bit of a saturation problem. So this chart is from OpenNEM, is one of my favorite websites. Here we can see the energy generation in South Australia. And what's happening now that renewables have achieved somewhat of a saturation point in terms of demand, on an intermittent basis, they're pushing the power prices negative. So if you're a wind generator, you've got a problem where, frequently the time that you're producing the product that you're trying to sell, the price for that product is ticking negative. And so that's a challenging financial model for anyone. On the other side of the, if we move forward onto the nuclear side, over on the next slide, what we can see is this a huge push towards this next generation of technologies. And by that, I'm talking about small modular reactors. So this table in front of you has 15 different SMRs on it. And you can see the companies which are progressing them. If you sum the market cap of those companies, you get to $220 billion of market cap, which is progressing this research and development effort. And I just want to, there's a huge range of designs here, but I just want to drill in on one because we do have exposure to it in the portfolio. And that's the Westinghouse eVinci micro reactor, which if we click forward should be highlighted in red. Okay, that's one of two designs by Westinghouse. They also have the AP300 design, which one of their representatives was down in Australia talking about a couple of weeks ago. But if we click ahead just to have a look at the eVinci reactor, this is really sort of excites the mind, or excites my mind anyway. So this design is, this reactor, is designed to be able to be set up on site within 30 days. That's a render of what it should look like on the top right-hand side. It will last for 8 years between, a single fuel load will last for 8 years before it does need refueling. The reactor vessel itself should last for around about 40 years. My estimates on cost of power generation come in below 10 cents per kilowatt hour. And the first one of these reactors is due to be commissioned in 2026. So, you sum all that together, you've got carbon-free, cheap, quick to assemble, electrical generation, perfectly designed for remote environments. And it might sound a little bit fanciful, but just when considering the likelihood that this technology sees the light of day, just have a glance in the bottom right-hand corner of the slide there. So that is the first nuclear submarine that was ever launched. That's the USS Nautilus. It was launched in 1954. And on board, it had an SW2 high-pressure water reactor, which was built by Westinghouse. So this company has an unmatched pedigree in small modular reactor designs. They've been doing this for over 70 years. And so I think it would be unwise to completely dismiss this technology, both as a potential earnings stream for Cameco through its ownership of Westinghouse, but also for the global power, decarbonisation and transition that we're going through. It's probably, if we just back up again once to the previous slide. I should mention that the last time I saw a table like this, it was the list of companies which were progressing COVID vaccines back in 2020. And Goldman Sachs put a great chart together along those lines. And I remember at the time, there was a lot of skepticism around, how long it would take to develop the vaccines, whether or not they would work. But then, history ended up saying that it all happened a lot quicker than what we thought. I think it's quite possible that there's going to be upside surprise from this space. And, it will be an area of substantial value add in the years ahead, both for the uranium price, but also for the companies that are exposed to some of these next generation technologies. I should also say that this is not necessarily all doom and gloom for the renewable sector. I mean, I think that the nuclear sector and the renewable sector can coexist quite happily. It's a often mentioned detriment of nuclear energy is that it can't scale up and scale down to accommodate renewables into the grid. That's only because the current reactors were designed sort of 50 years ago or more. And never envisaged the requirement to be able to ramp up and ramp down to accommodate renewables, whereas these newer designs definitely are. So they they both can coexist quite happily. I still think there's going to be reasonable or probably quite elevated metal demand for renewables going forward. But certainly, I think nuclear deserves to be part of the solution. And there's some fantastic IP coming towards us, in that regard. So. With that said, Paul, I might hand over to yourself for Q&A.
Thanks, Sam. And just on that last slide. So what you're kind of saying here, nuclear is heavily debated. Some love it, some hate it across the world because of the old-fashioned big nuclear power stations. But you're highlighting here there's new technology here now that can be used. Clearly, the uranium price over the last 4 or 5 months has had a massive run. Is this because of of this technology coming online and it's globally now people see that nuclear is not the bad way to help put energy into the grid?
I think there's certainly a couple of factors around the uranium price. I think first of all we've come to an end of a 10-year period of inventory destocking. There is a roaring deficit between uranium demand and supply. And that deficit has been made up through inventory drawdowns, but that appears to have come to an end. And now, supply and demand are going to have to match more closely. I think in terms of looking forward from where we are, I think the next generation of nuclear technology certainly has a huge amount to offer. And the deeper you dig into this stuff, the better it gets. I mean, if decarbonisation is electrification, which is an adage which is repeated, frequently, the amount of electricity you're going to have to produce to achieve or produce clean steel or completely decarbonise transport or decarbonise home heating, any of those huge sources of energy demand will require an enormous amount of electricity. At the moment, nuclear power produces around about 10% of global electricity demand. Uranium production is about 65,000 tonnes. So if we wanted to shift nuclear from 10% of global electrical supply to 100%, and assuming we have to do the same thing to uranium production, that only shifts a 65,000 tonne a year industry up to a 650,000 tonne a year industry, which is smaller than what the lithium market is at the moment. And that's because uranium is such an energy dense fuel. So when you start looking at the logistics of this, like, yes, there's some big hurdles in terms of social license, but in terms of raw materials required and the number of facilities required, it actually looks quite achievable.
And Sam, you talked earlier again about renewable energy, kind of stalling a little bit for a number of reasons. I'd love to get your take. There's been two big M&A deals in the US, oil and gas companies taken over to the, in the tune of $60 billion. What does that tell you? What's going on there? Is that saying that oil and gas are stronger for longer?
I think so. I think the IEA, which has been a very pro-renewables organisation, put out some charts just this week which suggested that oil and gas demand are going to be largely flat. Certainly coal demand is expected to roll over pretty sharply, but oil and gas demand is going to be more or less flat for a long time to come. But because every form of mining or energy production or raw material production has a natural decline rate to it, if you don't continue to invest in supply, it will naturally run off. And for oil and gas, that's about 8% per annum. So, it really is quite a sharp decline rate if you do not continue to invest in new supply. And I think that that's behind, or the belief, one, we're going to need more oil for longer, but also, we're going to need quite some time to transition to cleaner forms of energy generation, and that's where the view to the value add from those M&A transactions is coming from.
Sam, as always, absolute pleasure to have you on the program and get your insights. Much appreciated. You have a great weekend.
No worries, Paul. Thank you very much.
Thanks, Sam.